Hello, everybody, and welcome to the NASDAQ Dorsey Wright podcast for Wednesday, December the 30th, 2020. I'm Jay Gragnani, and here joining me this week is Ian Saunders. And it is, Ian, hard to believe that we're here at the end, the last couple trading days of 2020 before turning the calendar. Quite a year it has been on many different fronts, and we will certainly spend some more time next week in going through and reviewing 2020. But more importantly, what we wanted to do today is provide a little bit of recap, but also take a look at where things stand, what things are changing. We've seen some pretty interesting, noteworthy changes amongst some of our asset class ranks. As well as some notable activity that has been happening underneath the surface. And so with that said, as we step back now and look back at 2020 with just a couple of trading days in the books, if we look at it from a sector dispersion standpoint, we've seen a massive spread, just a huge dispersion between sector returns this year, with technology, XLK being the ETF there, is so far right now the best performing sector on the year. Up almost 42%, and that is nothing new for technology. It's been up in the top of the sector performance for a number of years now. 2019 it was the best as well. 2017 it was the best sector, technology being the best performing sector out there. Even 2018 it was a top 4 sector. So technology has just been one of those trends that we've seen that has been persistent and consistent over the past number of years. Similarly, on the flip side of that, despite the rally that energy has seen off of its lows, the energy sector XLE is still down over 35%, down 37% this year. And this year, 2020, will be now where energy has been the worst performing sector out of the just 11 broad sectors, the worst performing sector in 6 out of the past 7 years now. And, again, that's been one of those consistent and persistent trends where energy has just, perpetually over the course of the past few years just been a laggard. 2016 was the exception to that, where 2016 was, interestingly enough, energy was the best performing sector that year, but that was very much short-lived. And so, as we look at a lot of the themes underneath the surface there, looking at it from a sector dispersion perspective, you've got technology up there. You've got XLY, which is consumer discretionary, also communication services, as well as telecom up there. And, those sectors, and then at the bottom, you have energy and financials and utilities. And the bigger theme certainly there is, the more growth-oriented sectors have seen much better performance this year overall than value-oriented sectors have. With that said, though, we certainly have seen a notable move in energy, specifically if we look at XLE being the energy select sector SPDR ETF, it's seen obviously sold off extremely volatile back in the February, March general market sell-off during that time period. But we've seen a couple rallies. One happened off of the March, April lows, where XLE went from 23, rallied all the way to 46, almost doubled off of that time period, pulled back in the late summer, early fall time period, ultimately bottoming in October at 27, and has since rallied again, and now trades back in an overall positive trend. Again, this is XLE, back in an overall positive trend, has pulled back near some initial support at 37. And so right now, if we look at XLE and we look at, the general trend of the energy sector, we would certainly have to look at that and say it's positive. And the energy sector as well, Ian, has seen some notable improvement when you look at it from a fund score perspective.
Absolutely, Jay. I mean, the energy space has, as you said, seen no shortage of movement so far this year. And I mean, that's something that is not new to the energy space either. It's one of the kind of quicker moving areas that we have from a sector perspective. Like we saw back in the summer, quick to move up and quick to move back down in ranking from a relative strength perspective. But then looking at it from a fund score perspective, like you said, we have the XLE fund coming in at a current score of 3.7. With that extremely strongly positive score direction there, 3.61. So showing its move really from that bottom that we got back there in March, but not the first move up that it's seen. It would, like you said, we saw that spike up there in the summer as well. And when we look at that from the broader group scores perspective, we can go into the asset class group scores page. you can sort that page to just bring up the sector rankings. Energy is still ranked towards the bottom end of those particular sector rankings, but the average group score of the energy and natural resource group did move north of the 3.0 score line there over the course of the past few weeks, which is the first time that has occurred since October of 2018. We saw the big move up. If we shorten this down to look at only the near-term movement, we saw the big move up there from a relative strength perspective in the summer, brought the score right up to that 2.5 threshold by August, and then it began to fall back a little bit, moving down to an average group score of about 2.0. But the move that we've seen up this time brought it back north of that 3.0 score line, topped out there a little bit over 3.2, again, marking those higher levels that we hadn't seen since October of 2018. One thing to kind of keep in mind if we broaden out that score history, going back to the entire history of the group, is that the energy space has had a difficult time maintaining a score above, an average score above 3.0, which is generally viewed as your kind of more favorable groups. Obviously, you'd like to be the higher the better. The really ideal groups possessing that average group score north of 4.0. So energy still has a little bit of ways to go before reaching that space. But it's had a difficult time maintaining its kind of a favorable rank above 3.0 throughout much of the past decade. We can see that the energy space has been up above an average score of 3.0 a few times, a handful of times, going back the past 10 years, but it hasn't really been able to maintain that position for long, which is a very different story if we look at the prior decade. Looking back in some of the early 2000s, the energy space obviously kind of being on a tear throughout that time frame, maintaining a relatively high score throughout most of that time, of getting up in there until the 2007, 2008 timeframe. So will definitely be an interesting place to keep an eye out here, Jay, as we look towards the new year to see if some of this improvement can continue, if that space can continue to maintain that higher score. But this more recent movement that we've seen, as Jay touched on initially, has led to some interesting movement looking at the strictly relative strength-based DALI tool. On that tool, we have seen the commodity space, of which energy is going to be kind of underneath the hood as one of the subgroups within the commodity space, increase from a buy signal perspective to now be ranked third out of the 6 broad asset classes that we look at, overtaking the fixed income space there by just 1 signal. So important thing to keep in mind, we did see this move occur yesterday, but on the 28th, rather Monday on the 28th. But still that 1 signal separation, we do generally like to have a 5 signal separation before really cementing a change. But this won't have too much of an effect from a tactical tilt standpoint within any of you that follow those tactical tilt models, given that domestic and international still ranked in the top 2 spots there. But I mean, in looking at this move, it is certainly noteworthy, and we can see that this this is the highest that the asset class has been ranked in this DALI tool since April of 2019. It maintained a rank of 3 there for quite a while there, going back to the end of 2017. So definitely be another place to continue to kind of keep an eye out for, to see if that signal dispersion is something that we can that will increase as we look towards 2021. But I mean, in looking at the improvement, we've certainly seen commodities improve throughout the course of the month of December, moved up about 20-25 buy signals since the end of November. But really, I mean, the kind of the bigger story to look at there is a continued decline of the fixed income space as well. So while the improvement from places like energy, as well as the kind of continued maintenance of like base metals, that ranks highly from a relative strength perspective within the commodities group. But the fixed income asset class has lost there since Thanksgiving, since that November 23rd timeframe was ranked up above 190 buy signals. So it's lost 40 buy signals over the course of just the past few weeks there. So that will also be a place to continue to look at there, to see if that fixed income decline continues to drop it down in the rankings there, Jeff.
Yeah, and you know, you look at DALI now, and it's very much a case where the risk on asset classes are all 3 within the top half of DALI. And so that, you know, historically speaking, is a generally positive sign for the equity market, for more risk on assets, specifically as it relates to commodities. You know, commodities, there's a lot of base metals that have done very well this year. Crude oil is, the biggest piece of the general commodities bucket, especially, if you're owning commodity-based ETFs, most of them, a lot of just the broad-based commodity ETFs are going to own a lot of energy. And because in a similar way to the S&P 500 is cap-weighted, meaning the largest stocks in the S&P 500 get the largest weighting, a lot of energy-related commodity indexes, sorry, not energy related, just broad-based commodity indexes are going to tend to own more energy just because that's a production weighted index. So the weight towards energy and crude oil specifically, and a lot of these broad-based commodity baskets like the GSCI commodity index or any of those, energy is going to be very, very important. So as we look at energy today, as a matter of fact, it is currently ranked #1 in a matrix of about 20 other individual commodities in there. So energy being a very big component of that. Energy here recently has been a very strong component of that. It certainly was not the case earlier this year. I mean, you go back in April, and the May 2020 contracts in crude oil actually turned negative there for a time being, and that's one of those things that seem so long ago that actually happened. But another one of those things, just the weird phenomenons that have transpired so far this year. You can add that to the mix with crude oil futures actually turning negative at one point back in May, as nobody wanted to take delivery of crude oil back then. Nonetheless, you look at crude oil, it's back in a positive trend and trading back almost close to $50 a barrel. So it's, while still down about 27% on the year, is back to the highest level that it's been since February of this year. And so, as you look at crude oil, whether you're looking to gain exposure to energy via an ETF, like an equity ETF like XLE, that's one way to gain exposure to, kind of commodity related stocks. Or if you're looking at other actual commodity, there's a number of ETFs out there that exist that allow you to participate in crude oil prices. So the one caveat I would say with that is just understand how those commodity ETFs are gaining exposure to crude oil. And that was one of the things that came out of earlier in the year, where some of these futures prices, the contracts actually turned negative. Some of the commodity ETFs, namely USO, which is the biggest one, went from being a pure front month roll ETF to expanding that out a little bit and diversifying across a number of different contracts, as opposed to being so heavily invested in just the front month contract. But some will seek to just be short on the roll curve, meaning 1 or 2 months out. Some ETFs are designed to invest in 12 months out. Some use what they call an optimum roll process, to where they try to mitigate any negative effects from rolling those crude oil futures contracts underneath the surface. So that's all to say that there's a number of ways to gain exposure to crude oil. Just understand how those ETFs and those funds are gaining exposure to it, and also know that a lot of them will generate K-1 statements because they're investing in futures contracts. So those are just some things to be aware of and be cognizant of as you're looking to, or potentially looking to, gain exposure to crude oil or commodities at large. But the improvement, across the board, obviously commodities moving up into number 3 in Dolly, but the commodity related theme has certainly been seen within the equity market as well.
Absolutely, Jay. I mean, this improvement from crude oil is certainly very noteworthy, and some other noteworthy improvement, or at least continued ascension higher, that we've seen from some other areas outside of the commodity or even the domestic equity space has been Japan. Japan has been an area, kind of maybe somewhat surprisingly, been in the headlines a little bit more over the course of the past few days, with the Nikkei 225 index moving back up to 30-year highs, with that respective index movement over the course of the past few days. Coming in and looking at a Japan representative, looking at the iShares MSCI Japan ETF, ticker EWJ, definitely can see that really rapid improvement and sustained improvement over the course of the past few months. This fund doesn't quite go back 30 years, but this movement over the course of the past few weeks, continuing higher from the low that we got back there in March, all the way down at 42. moved higher to give 3 consecutive buy signals. That last buy signal also pushing it higher to get it back in a positive trend as it moved to 52 back there in April, and then continued straight vertically in a column of X's, at least here on the default chart, bring it up to its current level at 67, marking a new all-time high for this particular fund. Sitting up there with that last C that you can see here for those of you that might be following along via YouTube. And so looking higher at this column of X's, it started all the way back down in April, as I said, down at 47. It's continued to stream higher of 20 points in that single column up to the 67 point. Does leave us on a little bit of a stem, as we can see here for EWJ, sitting in fairly heavily overbought territory, north of 100% overbought at these all-time highs. So while we've seen this kind of more recent strength pushing the broader Japanese equity space back up towards highs, one thing to kind of keep in mind is that we continue to like to look at, and we see not even just Japanese equities, but really kind of any equity space, any equity index reaching highs, how many names are participating in the movement underneath the hood there. And we actually do have, we track that through bullish percent indicators, measuring the percentage of stocks underneath the hood that are trading on point and figure buy signals. And we actually have bullish percent indicators, not just for the domestic space, the BPNYC being that most well-known one, but we have those across other international indices and equity markets as well. So if you're following along on the platform, you can type in the BPTO-TO to get the bullish percent for Japan, for the Tokyo Stock Exchange there. And interesting thing to note, even though the broader Japanese equity space is pushing towards highs, at least 30-year highs there for the broader equity market, the bullish percent is not doing the same thing. We saw this bullish percent chart actually reversing down into a column of O's last week on the 22nd, after reaching a high level of 84% back in June. It's continued to kind of ascend lower. We got a big fall off there in July, and then kind of a period of consolidation there from a bullish percent or participation standpoint. A little bit of a movement higher there in November, getting back up to the 62 level, not nearly as high as the previous 70 or 84 levels that we reached in months prior to that. And then that movement over the course of the past week or two has led this indicator to reverse back down into a column of those, down to a current level of 54%. And in looking at forward returns from this point moving forward, this chart level from 50 to 75%, the kind of second quartile on the chart, if you will, maybe perhaps unsurprisingly, we see the majority of trading days for this indicator going back throughout the entire history we have on the site back to 2003. The indicator spent a majority of its time in that level, either in a column of X's or in a column of O's, from that 50% up to 75% level. Most of that time has been spent in a column of X's, but about 14% of the trading days since 2003 has been in a column of O's at this particular level, from in that second quartile on the chart. And interestingly enough, we actually see from a forward return standpoint that in a column of O's between 50 and 75% has led to kind of the weakest returns for the Nikkei 225, looking forward 1 week, 1 month, 3 months, 6 months, and even 12 months. Even though some of those returns are positive, they do tend to be weaker than if the chart were in other areas, maybe a bit higher, showing more participation, or even lower, maybe moving off the bottom. So one interesting point to kind of keep in mind as we're continuing to see Japan in the headlines, reaching those highs, that we are seeing a little bit of a lack of participation there within the individual names in the Japanese equity space. That'll certainly be an area to keep an eye out for as we move into 2021. But a little bit of a different story than some of the participation and movement that we're seeing in the domestic equity market, Jeff.
Yeah, that's right. And, you look at that bullish percent, and that, looks to be a very different picture than you get when you look at something like the EWJ. And again, something like EWJ or broad-based indexes tend to be capitalization weighted. And so in the case of EWJ, you've got Sony or Toyota as the largest, Sony is the second largest, and then SoftBank Group up there at number 3. So those 3 names in EWJ, so in the ETF, account for about 10% of the move of EWJ versus the bullish percent, which is an equal weighted indicator, meaning every single stock has the same vote or same weight inside of that indicator. So certainly something to pay attention to, something to observe if you're looking at Japanese equity exposure. But when you flip back to the U.S. market, you see a similar picture in the sense of the U.S. equity market index is all hitting new highs. Not that we're seeing a similar bullish percent picture, but at least on the charts of the indexes, the S&P 500 specifically, continuing to push to new highs up on the chart, 3740 being a new high for the S&P 500 right now. And it has done so, relatively methodically since the market bottom, generally producing a series of higher tops and higher bottoms over the course of the past 9 months now. As we look into the end of the year and head forward to next year, the chart right now, the S&P 500 specifically, does show some initial support in the 3640 area, and then again down after that around 3520 to 3560. So a fair amount of strong near-term support there for the S&P 500, with the bullish support line to the long-term trend line being down at 3,200 right now. But as we look at the indexes, and you could pull up any index today and see a very similar picture, whether it's the Dow or the NASDAQ 100 or the S&P, all major U.S. equity indexes pushing to new highs, and doing so with pretty good participation. And another way to kind of look and measure that would be the percent of stocks in the S&P 500 that are trading in positive trends. PTSPX is that indicator, and what that is measuring is the percent of the S&P 500 stocks that are trading above their bullish support line or in an overall positive trend. And we continue to see the PTSPX chart continue to push well up into the 80s, moved up to 86 earlier this month, which is generally a very healthy sign for the market, as 86% of the S&P 500 names are trading in overall positive trends today. Again, that tends to be a pretty healthy environment for the market. Readings north of 50% on this indicator are generally healthy market environments, and basically all that tells us is that a majority of stocks, if we're above 50%, a majority of stocks are in positive trends. And today that majority is very overwhelmingly, the overwhelming majority of stocks in the S&P 500 are trading in positive trends today. So, as we head into the new year, we're doing so on generally positive picture from an indicator perspective. As PT charts and BP charts generally are positive. We see U.S. equities, international equities, commodities are the strongest asset classes from a dollar perspective. So entering the new year, and we're doing so on a positive foot with respect to the indicators.
Absolutely, Jay. I mean, and looking back over the course of this particular chart for the PTSPX2, I mean, one thing that we've continued to touch on is that just the high levels, I mean, might just intuitively lead you to believe, I mean, if we're high, it has to come down, right? But I mean, we can see throughout the history of this chart that it actually has had a tendency to remain in elevated territory for at some points a prolonged period of time. So just because we're up at such high levels doesn't necessarily mean that the beginning of 2021 is going to see that turn around. But needless to say, that's why we have the indicators, and that's why we can set alerts on them through the chart page and continue to keep track of that as we head into the new year. Another area that we have been looking at over the course of the past couple weeks here, as we wrap up the year 2020, we have our annual, what we call 12 Days of Christmas article series coming out in the Daily Equity Report. One thing I did want to mention here before we wrap up this afternoon with the last podcast in 2020, but coming in here, the 12 Days of Christmas series this year is focusing on enhancing your process with scalable customization in 2021, which is taking a look at a few different kind of background methodologies that we've had on the platform. So looking specifically there at the kind of relative strength and matrix-based approach, as well as the technical attribute and fund scoring system that we have that we've touched on a little bit throughout the course of the conversation here today. And a bulk of the latter part of the series has been focusing on the new custom models tool that we have available here on the NASDAQ Dorsey Wright platform. So if you are a subscriber to the platform, you are a subscriber to the research there, definitely be sure to go in and check out those articles. We will be having The wrap-up article, the last article, the 12th day of the series, is kind of a summary of each day so far. Each of the links are available at the top of each of the articles, like the one we had there from yesterday. And that summary article will be coming out there on Tuesday. So definitely be a good place to look out there. Start off the new year 2021 with some process enhancement potentially there. So definitely a good thing to check out.
Absolutely. Well, with that said, I think that's a good place to stop here, Ian. Appreciate everybody joining us this week. Hope everybody has had happy, healthy holiday season. Happy New Year to everybody, and we'll look forward to talking to you in 2021.